Good morning. It's a great pleasure, great honor to be invited here to speak this morning. This morning, as mentioned, I'm going to focus on the global economy. First, I'm going to talk about what's happening to the global economy now. It's slowing. But even though it's slowing, that does not mean that you should be pessimistic. There is an outside risk of a global recession, so we need to take the downside risks very seriously. But more likely, policy stimulus, monetary and fiscal stimulus, will allow the global economy to stabilize as we enter the new year. And in the second part, I will focus in particular on policy, on what that means for fixed income markets. And third and finally, I will conclude. But let's begin by looking at the world economy. Let's hope the clicker works. Perfect. Uncertainty is the key word. When you look at the global economy now, I think it's important to step back and appreciate that there are two significant underlying factors at work. The first is the shift in the balance of power. We've talked about the shift in the balance of power for so long, people can tend to become blasé about it and think, I've heard about that, yeah. But the shift in the balance of power is phenomenally significant, and it is ongoing. What it means is that more of global growth is coming from the emerging economies, currently led by China, but likely to be followed by other countries. It's a combination of perspiration, more people buying more things, producing more stuff, and inspiration, the fourth industrial revolution, that Western economies too will share in. So the shift in the balance of power means that more of global growth is coming from outside Western economies. And in some respects, Ukraine is relatively well placed to benefit from that. But the second big underlying theme is the aftermath of the global financial crisis of a decade ago. The aftermath of that still lingers on in the sense that growth in the West is weak by historical standards. Interest rates and inflation are low. This is perhaps highlighted most by America, where the current economic cycle is the longest in history. The current growth phase has gone on longer than any previous growth phase in America. Yet, not everyone appreciates that, because the pace of growth has not picked up to the rate one might have previously expected, largely as a legacy of the financial crisis. But let me highlight this particular graph that's often not appreciated. This is the size of the world economy. We don't always talk about the size of the world economy. This is in trillions of dollars. Let me cite three figures: 32, 62, and 86. What do I mean? At the beginning of this century, the year 2000, the world economy was $32 trillion in size. The day the financial crisis started just over a decade ago, the world economy was $62 trillion in size. At the end of last year, according to the IMF, the International Monetary Fund, the world economy had grown to $86 trillion in size. Despite everything, and if you sit in London or in New York, you might often be taken aback by this. Despite all the worries we have in Western economies, the global economy has continued to grow. These are nominal figures. Some of this is inflation, but as we all know, inflation has been relatively low. But the vast bulk of it is real, genuine economic growth. So when we measure and look at the world economy now, which is slowing down, we have to not lose sight of these underlying longer-term and positive factors. But when we look at the world economy now, let's look at the growth rates. This is IMF data, global GDP. The world economy in 2008 was hit by the financial crisis, and 2009 had an outright shrinkage. Global GDP fell. The only time that's happened since the Second World War. If one looks at the axis on the left, generally speaking, economists on this measure of the IMF tend to think anything around 3% is indicative of a global recession. So when you actually fall by less than zero, that was a big hit. But generally speaking, as you can see, in recent years, global growth has hovered around 3.2, 3.4. But twice in the last few years, financial markets have been taken by surprise. The first time global financial markets was taken by surprise was as we were going through 2016. The markets then were talking about global recession, another financial crisis. What happened? The world economy gathered momentum and really grew strongly in 17 and 18. The second time markets have been taken by surprise in recent years, first was 2016, when the world economy proved to be stronger. The second time was last year. Markets at the beginning of last year were thinking global growth would continue to be strong. Hence, expectations were for interest rates to rise. Last year, the world economy slowed. Markets were taken by surprise, and that slowdown has continued. Three factors led the world economy to slow last year. The trade dispute between America and China, which continued to escalate. While it was initiated by President Trump, it also highlighted or reflected underlying geopolitical tensions. The second factor that led to the slowdown last year was monetary policy tightening led by America. And third, China tightening policy. Let me focus on each of those. I'll begin with trade, then I'll talk about China, then I'll come on to policy. But of those three factors that led to the slowdown last year, two of the three are now being reversed. Policy in China, having been tightened last year, is now easing. Interest rates, which were going up globally, and monetary policy being tightened last year, policy is now being eased, led by America. The big worry people have is about the trade dispute, because it's not clear which direction that's going. Let me highlight what's happened to global trade and to other factors. As a result of this global slowdown last year, the markets are in particular focusing on what's happening in the industrialized economies, led by the OECD. This is one of the most important indicators, I won't say most important, it's one of many policy indicators that markets look at and policymakers look at. It's the lead indicator from the OECD, the Western economies. It's continued to soften as we've moved through this year, although now they describe it at the OECD as stable. So having fallen, it's starting to stabilize. But very importantly, and this is of particular importance to central banks, is that since the beginning of this year, inflation expectations globally have continued to ease. The easing of inflation expectations was a legacy of the slowdown last year. Now, here in Ukraine, inflation expectations are easing. The central bank is cutting rates. One of the big issues globally is whether markets are too complacent about inflation. When one looks at America, Britain, Western European economies, and Japan, in recent years we've seen labor markets tighten. Employment has been created. The pace of employment growth, admittedly, has started to slow recently. But if we were here 10 years ago or 20 years ago, central banks would have been indicating that against that backdrop of a tighter labor market, they would have been expecting wages to rise, inflation to pick up, and they would have been prepared to tighten policy by raising rates. But because of the factors I mentioned at the beginning, the shift in the balance of power to the emerging economies, and the aftermath of the global financial crisis, what's really happened in the West is that even though labor markets have tightened, wage growth until recently has not really picked up. In the past, wages were driven by the relationship between workers and unions. That's still vitally important, particularly if countries decided to retreat from globalization. But in addition to that, globalization, technical change, and the role of the financial sector, financialization, has all driven to keep the share of wages in global income under pressure. So even though labour markets are tightened or have tightened in recent years, the surge in wages has not really been as one might have expected. Wages are picking up, but at a subdued pace. And as a result, the inflation picture globally is still pretty subdued. So let me just reinforce the message. Global economy slowed last year. The OECD, Western economies, have lost momentum, but now are stabilizing. But inflationary pressures and inflation expectations appear subdued. What then about those three factors that led to the slowdown last year? Let's begin with trade. The Dutch organization CPB produces the best guide to global trade, but there are other measures. This shows the trend, 3 months on the previous 3 months. Latest figures out this week for July showed a rebound in the monthly trade figures. Indeed, Korea and Taiwan, which released their export figures earlier than others, also showed a turnaround very recently. But generally speaking, global trade has slowed. This is a legacy of the global slowdown, but it's also a consequence of the trade dispute with the States. The question is whether that trade dispute will start to be de-escalated. One would imagine for geopolitical reasons, while President Trump will still want to be talking tough with China ahead of next year's presidential election, he might want to minimize potential damage to the US economy. Because everything suggests from economic analysis that the current trade dispute will be negative for US consumers and Chinese consumers in particular, and also negative for companies in global supply chains. So the trade dispute is still the big worry out there. And the data shows trade has slowed, but importantly, the last month's figures suggest a stabilization, maybe a turnaround. It's often said in economics, never ignore 1 month's figures, but also never read too much into 1 month's figures. So we have to wait and see. But it's not just the trade dispute. Industrial production has been incredibly weak. This is partly because of global trade slowing, but it's also reflecting underlying structural factors, particularly in the auto sector. The global auto industry is very weak indeed. And these figures on industrial production show, as we all know, there are cycles, but as you can clearly see, the recent trend is weaker industrial production. Now, the world economy is not driven by manufacturing or industrial production. They are very important. Politicians always tend to think manufacturing is the only thing that matters because you can have a picture taken with a yellow helmet on. But the worry for economists is not only the importance of manufacturing itself, but in the past, slowdown in manufacturing sectors has tended to be followed by slowdowns in service sectors as well. So one needs to watch the manufacturing sector in particular. One country that looks very vulnerable indeed is Germany. This is the IFO measure of industrial activity in Germany. And what we have here is the expectations component and the current indicator. The top figure is the current conditions. It picked up in the last month in Germany, having fallen for 5 previous months. There was relief in the German media about this. But as you can see from that top graph, that's a weak trend. The expectations component, however, didn't pick up in the last month and continued to weaken. Germany was in recession in the second quarter. These sorts of figures would suggest that Germany will go into recession. Germany economy contracted in the second quarter. These sorts of figures would suggest it could contract in the third quarter as well, and therefore go into a technical recession. Definitions of technical recessions make big media headlines, but you need to keep them in context of the longer-term trend. This helps explain why Chancellor Merkel recently seemed to suggest that Germany might be willing to start easing fiscal policy. Although if you speak to other people when you visit Germany, you'll appreciate that not everyone agrees that that's the path ahead. So, three factors accounted for the global slowdown last year: trade, China, and monetary policy tightening. The trade picture maybe will start to stabilize. It still is the big worry for everyone, because if the trade dispute escalates, then those trade figures I've shown you will deteriorate, the industrial production figures will deteriorate, and economies like Germany, key to global supply chains, will fall into recession. What about China? Look, I could give you thousands of figures on China. I've shown here the most important indicator for the markets, which is the Chinese currency. When the figure goes down, it means the Chinese currency is appreciating against the dollar. When it goes up, it shows the Chinese currency is getting weaker against the dollar. And the recent trend has been weaker. Now, let me step back from this and talk about China. China's official growth forecast for this year is growth of between 6 and 6.5%. Let's put this in perspective. While this might be a 30-year slowdown for China, weakest growth for 30 years, 6.5% would mean that China, this year alone, adds an economy the size of the Netherlands. And the Netherlands is the 17th biggest economy in the world. Were China to grow at only, in quotations, 6%, it would add an economy the size of something like Saudi Arabia, the 19th biggest economy in the world. As China gets bigger, slower paces of growth are still pretty important. Now, at the beginning of last year in Davos, China's lead economic spokesperson, Liu He, gave a speech, and I characterized it as him highlighting what I would call the 3 Ps. He didn't use the 3 Ps, but it's the best way to think about it. P, pollution control. Lots of people misread China on the environment. China has environmental agenda, the green agenda, very central to their 5-year plan. So pollution control. Second P was poverty reduction, getting rid of extreme poverty in China. But the third P is most important for you guys looking at the markets, you people looking at the markets, and that's prevention of risks. Global markets have been worried about a build-up of debt in China and the build-up of leverage in China. The Chinese themselves are conscious of this, hence last year they tightened policy. The trouble was, as we moved through last year, the combination of Chinese policy tightening plus being hit by the trade dispute meant that the Chinese economy weakened far more than the markets expected, than policymakers envisaged. As a result, at the end of last year, they went into reverse. They don't use the word reverse. They started to ease policy. In particular, this year, they've cut cut corporation taxes aimed at small, medium-sized firms. And this year, they've started to ease reserve requirements to make it easier for banks to lend to small and medium-sized firms. The way to think about it is that China is fine-tuning their policy, but as the economy gets bigger, it becomes harder to run China the way it used to be run. So the trend for the Chinese economy is up, but you should expect far more volatility in that trend than we've seen in recent years. But importantly, the Chinese recognize the need to be easing policy, and that's what they're doing. They still call it a prudent monetary policy and a slightly looser fiscal policy, so they're still trying to tread a difficult path. But to conclude the first part, the world economy is slowing. One of the key factors that led to that slowdown, the trade dispute, remains a focus of attention. A second factor that led to that slowdown, China tightening, is now being eased. But what about policy and what about markets? And let's focus in particular on monetary policy. This is the balance sheets of global central banks. This is equivalent to central banks printing money. When it goes up, they're pumping money in, they're printing money. And this is the balance sheet of the Fed, the European Central Bank, the Bank of Japan, and the Chinese Central Bank. After the global financial crisis, they printed money, big scale. Recent years, it's stable because, as I'll show in a second, America stopped. But the European Central Bank, and in particular the Bank of Japan, have effectively continued to print money. Although the Europeans stopped for a short while, they're starting again. So printing of money has been one thing. This is real interest rates. Now remember at the beginning I said one needs to differentiate, or I mentioned the importance of emerging economies versus advanced economies. When you look at monetary policy and at real interest rates after you take out inflation, emerging economies in recent years, real interest rates have been stable. Central banks in the Western economies have been cutting rates, real interest rates are low. This is pretty significant, what's happening in Western economies. But for the Fed in particular, and everyone else, the question is, where should rates be going to? In August each year, global central bankers meet in Jackson Hole in Wyoming. One of the big debates this year was, it should be said it was a big debate in previous years as well, is where is R star? Where is the neutral, natural rate of interest? And for global central bankers in the West, what they seem to conclude, and academics conclude, is that the trend has been down for interest rates, and it's all pretty much bunching around the same level, but significantly below zero. So what they're saying is that we've eased rates a lot. Maybe we have to get used to rates remaining low for some time. Now, what has the Fed been doing, and how will that impact us now? This is the balance sheet of the Federal Reserve. The scale, sometimes you can make graphs to look more dramatic. You can sometimes change the scale. But you don't need to do anything dramatic when you look at the numbers on the left-hand side. Going from just over a 2 trillion balance sheet to a 4.5 trillion balance sheet is pretty big in a few years. But in recent years, the Fed has been tightening by taking money out. And that's contributed to some of the challenges in the repo market, as we've seen recently. But it's also contributed to a slower pace of growth, maybe, relative to what it would otherwise have been. And then this is the Fed. The Fed, a couple of years ago, the thinking at the Fed was that they needed to raise rates to have ammunition to ease if the economy slowed. Now, you might say they were successful in being able to raise rates because this year they've twice been able to cut. But when you look at where rates peaked this time to previous cycles, you can see a significant trend. As global inflation under global competitive pressures has eased, central banks have not needed to tighten aggressively in the upswing. I would say one of the challenges is this, that when you look at policy, whether it's monetary policy or fiscal policy, the question is whether in good times governments do enough to get their house back in order, and also in good times whether central banks raise rates enough. Prior to the global financial crisis, I used to take part in a regular event at the BIS, Bank for International Settlements. But ahead of the global financial crisis, I was one of only 2 UK economists saying there would be a deep, imminent recession. But one of the issues I used to say then was that rates low, rates rising gradually is fine, but maybe at peaks of cycles, we need to have rates going up higher. Just as at peaks of cycles, governments need to raise more money or go into budget surpluses, not still run deficits in good times. Because the challenge always is, when interest rates are low, markets do not price properly for risk. But coming back to the cycle now, the Fed tightened through the balance sheet, then they tightened through interest rates, but now they are cutting interest rates. Now, I'm going to show you 2 graphs. They might look quite fuzzy, but these 2 graphs will help explain, in my mind, why, when you look at the Fed now, it's unclear what they will do next. When the Fed cut rates recently, the markets criticized them. Unfair. 5 members of the Fed still implied they wanted to raise rates. The question was whether this was a continuation of an easing cycle where rates continue to fall, or whether this was a sort of mid-cycle, as in 2005 and 2009, where they just ease because they need to. These are two Fed measures. This is a Fed measure from the New York Fed of the probability of US recession, 37, 38%. This is, though, based on yield curves. This is another measure from another US Fed based on economic data, and their probability of a US recession is close to 0. So the markets, and this is reflecting the market, are far more pessimistic than the data suggests, which suggests to me that the Fed, while they will still have a bias to ease, will move gradually. In terms of fixed income markets, this is taken from the Bank for International Settlements. The line is yield in America and Europe, and the other parts are the explanation of what's causing yields to fall. And the data from the Bank for International Settlements shows two factors explain yields falling. One, expected inflation easing, and the other is the term premium falling. I'm sure you all know what the term premium is, but basically, effectively, one way to think about it is if the term premium falls, even though short-term rates might be going up, the markets expect long-term yields to stay low. And that reflects, you could argue, worries about longer-term growth, expectations longer-term that inflation will stay low, expectations that whatever the Fed does and other central banks do, policy rates can't really keep on going up. But, we have a couple of challenges. Again, from the International Settlements, BIS, 1/3 of global government debt is yielding in negative territory. What that means is people aren't looking for a return on their investments, they're looking for a return of their investments, or indeed with some taken out. It suggests people are some investors are ultra cautious. It does mean, though, that governments can borrow very cheaply if they want to justify fiscal spending. The other challenge is this, a search for yields. Now, your Ukrainian market is going to be one beneficiary of this. As your central bank eases and your yields are high, international investors will naturally become more attracted to your market. But this is one of the areas of concern. When rates are low, markets don't price for risk, they search for yield. And the recent area that many people have highlighted is leveraged loans. Bear in mind the scale is $1.25 trillion, still pretty lot. Previous scale on the previous slide was 15 trillion. But the worry is that investors might not be pricing for risk. That doesn't mean that a financial crisis is inevitable. What it means is that if growth was to disappoint, or if interest rates did not keep falling, or if interest rates rose, then some of these investments would start to look more vulnerable. Debt levels are very high. Debt levels have continued to rise, but against the backdrop of low yields, one should expect not just monetary policy easing, fiscal easing. I'm going to take 2 minutes to talk about Brexit because I was asked to mention Brexit, but I could spend an hour talking about Brexit. There are many different messages, but I think first and foremost, you need to appreciate this is a political crisis in the UK. There are many different ways of looking at this, but I saw this used by someone earlier this year, and I thought this captured for international investors by votes. In 2016, we had the biggest vote in British history. 17.4 million people voted to leave. 16.1 million people voted to remain. So it was 52% versus 48%. So it was still tight in some respects, but the scale of the vote was significant. What we have, though, is a big problem in Parliament. By constituency, 406 constituencies voted to leave. These are constituencies that elect MPs. But this is the next part, which helps explain why the two major political parties in the UK may be in such a bind about this. The Labour opposition party, 148 of their MPs represent constituencies that voted leave, 84 that voted remain. The opposition Labour Party is in a bit of a turmoil as to their policy. For the Conservative Party, it was largely Leave constituencies. There are 12 regions of the UK. 3 voted to remain: Northern Ireland, Scotland, and London. 9 voted to leave: Wales and the 8 regions of England outside of London. In 1975, when we voted to go into the Euro, or to stay in the European Economic Community, the most Euro-enthusiastic part, or a pretty Euro-enthusiastic part, was England. England has become pretty Eurosceptic. But this is the challenge. Against that backdrop, and even against this backdrop, you can get the impression that it's a divided country. By number of MPs, 160 said they voted leave, 486 said they voted remain. Doesn't mean they would all go this way. But I think the message is that we have a political crisis, and a political crisis that is not easy to resolve. What's important, though, in economic terms, and as I said, I could spend lots of other points on this, is that what we've seen in recent years is what all economists, no matter how they probably voted, agreed on before 2016, that the UK is the most open, flexible, and dynamic global economy. It adapts and changes to shocks quicker than anyone else. And this is captured here by the jobs data. The unemployment rate has continued to fall. And since 2016, the UK has added 1 million jobs. Not all of them may be as high wage as we would like. It's also, since 2016, the 3rd highest in terms of attracting inward investment after America and China. And indeed, London, the global city, has more skilled workers than any other city in the world. So when one looks at the UK, the politics is still a challenge. The economy is far more adaptable and flexible. People voted to leave for different reasons, but most of the analysis showed it was primarily sovereignty, then migration, and then the economy. So different reasons, a different mix, but the economy is in far better shape than maybe the message you get from the UK politics on the TV. Final point before I conclude, the dollar. As this goes up, the dollar is stronger. We have a period of dollar strength at the moment. It's a safe haven, but we've had previous periods of dollar strength that have been more dramatic in the past. This adds to challenges for emerging economies, but the dollar, despite US rates coming down, looks likely to remain pretty positive. Conclusion, how should we put all that together? Let me just say 4 things, maybe, or a few things. First, globalization still drives the world economy, even though in some areas people talk about globalization being in retreat. Investors are still looking globally. Second, the world economy. Whichever economy you look at, the outlook depends on the interaction between fundamentals, policy, and confidence. The fundamentals are mixed, but what we saw last year was 3 factors slowing the world economy: the trade dispute, China policy tightening, and monetary policy tightening led by America. The fundamentals are mixed, particularly given the trade dispute. Policy, we're now seeing policy stimulus, monetary policy, stimulus in China, and likely fiscal stimulus. That should allow, in my view, the global economy to stabilize as we end the year. But confidence is a big unknown. If, for whatever reason, there was a loss of confidence, then the tail risks of a global recession and a financial crisis become possible. Confidence is difficult, nigh impossible to predict. But when you look at the outlook, it's the fundamentals, policy, and confidence, and policy is helping. In terms of markets, monetary policy is key. And let me talk about the 3 S's here as I conclude. A decade ago, global monetary policy was characterized by the 3 S's. It was sizable, it was synchronized, and it was successful. Now, 3 different S's characterize global monetary policy. Central banks look at the scale of the tightening last year or the scale of the easing this year. They look at sequencing. Should it be shrinking the balance sheet or raising rates? Or now, should it be raising the balance sheet, boosting it, or cutting rates? And shocks. What we've seen is that markets and economies are susceptible to shocks if monetary policies tighten too much. Therefore, they should benefit if monetary policy is eased. And then finishing by looking at the Ukraine, you are an economy, I'm not going to comment too long on it, which has attracted international attention, more so because of your politics 4 months ago with the new president, and more recently, obviously, because of your leader's discussion with President Trump. But when one looks at the economy, your strong growth figures in the second quarter attracted attention. If you keep inflation under control and you grow your nominal GDP rate, growth 3%, inflation down to 5-6%, nominal GDP rising at 9%, that keeps your debt to GDP ratio in check, and it would allow interest rates to trend lower in a gradual and predictable way and make your market of more interest to international investors. Thank you for your time.